Welcome to Making Money with Matt McCall. I am Matt McCall. Thanks for joining me today. It is Thursday, January 20th. Man, time's flying already. 20 days into the new year. Not the best start for stocks. The Nasdaq yesterday moved into what we call correction territory. Pull back at least 10%. We're going to talk about that. Getting a little bit of a bounce today. The ARK Innovation Funds continue to get crushed. Again, big bounce today. Is this a one-day bounce? Is there more to follow through? Plus, I got a little 4-pack of stocks for you that are beaten down, probably never heard of them, that I think you should add to your watch list right now today. All this and more coming up right now on Making Money. Again, this is Matt McCall. Thanks for joining me. It is January 20th, 2022. It's one of my cousin's birthday. I can't remember which one, so I'll probably just text a few to see if I get the right one. And it's kind of, if you might see my look today, it's kind of like a company day. I got my Stansberry hat on, our parent company MarketWise shirt. So I thought I'd go a little casual. It's a rainy day here in South Florida. So it was a nice day to kind of support the company as I'm down in Florida away from the headquarters. So let's talk about the markets here for a minute. We moved into correction territory yesterday, as I mentioned, for the Nasdaq. I'm going to pull up that chart here in a second for you, but what that means is it's a great headline, and it does mean something, and it means that we've pulled back at least 10% from a high. And that doesn't happen that often, but it happens pretty often. Typically, the indices, they move into correction territory about once every 12 to 13 months, about once a year, let's call it. When I did my predictions, and a lot of times they're fun, and they're just educated guesses, honestly, for 2022, I said there's going to be several corrections, and here's the first one already, and I think we could see more. I think it's going to be a really volatile year. All that being said, at some point between the start of the year and at the high that we're going to have throughout 2020, I believe you'll see a gain of 20% in the S&P 500 and possibly more in the Nasdaq based off the fact that the tech stocks are beaten down and due for a bit of a bounce. So let's take a look here at the chart of the Nasdaq. As you can see, we broke down yesterday. I mean, we closed near the lows of the session. That's what that means. And again, from the high that we had in November, so a pretty quick correction. It took about 2 months or so for a correction, so not abnormal. And then we're getting a bounce today. This is still early in the morning. We've only been open for about 47 minutes here, and the index up about 1.64%, but a big move. So is this what they call a dead cat bounce, where it's just we've sold off so much, you're going to get a bounce? Or does this mean that we've had a capitulation? We're now at a level of people are going to start coming into stocks? I don't know the exact answer to that yet. I'll let this play out. But I will say that the one good thing is that we do have a bit of a support. I'm going to draw this to the line here. As you can see, if you go back to February, we hit a level around 14,226. We came back up April, I should say, hit it again, failed. We hit in June, failed for about a week. Then we broke out. And then you come back and you test it in July. We tested it again in August. We tested it in October, and we're testing it again. So this is a real important support level. It did break the blue line, which I don't like, which is a 200-day moving average. But again, technical analysis, I've said to you many, many times, it's not black and white. It's very gray. So you have to be, and even though it is scientific, it's based off emotion. So sometimes you see these breaking of supports for a day or a week, and then it ends up being this massive rally back because it doesn't always come down to the exact level. So keep that in mind. The way I look at the Nasdaq right here is I'm going to give it a few days, but I do like this let's call it 14,200, 14,200, which is about 370 points from today. It's about 140 points from where we closed yesterday on Wednesday. So keep an eye on that, and that's a level to watch here. Now let's take a look at the SPYs, the SPY. This is the S&P 500. I drew this line for you on Tuesday, and we broke that. We're trying to rally back. We're up about 0.9% this morning. But the other line is the price support line, and I can actually flip this around for you and make it look nice and make it easy. And it may not look nice, but you get the gist. So what you're going to see here is it's this 450 level on the SPY has been really important. It rallied up against it, couldn't, broke out, test. If we break this, you'll probably go right down to the blue line, the 200-day moving average. But the way I'm looking at it again here is we're near some support levels when it comes to the major averages, which tells me I don't panic sell here. Well, I never panic sell. But you definitely don't panic sell here because you're close to support that is potentially a rally. And I'm going to go down here. This is a line here, this white line. And this is volume, obviously. The green just means an up day, red down day. So we've had actually a lot of big down days. We've had a lot of money coming out, which isn't the greatest sign. But down here, this number is flopping around. It's at 30 now. This is what's called the RSI, the Relative Strength Index. And this is, it sounds very confusing, but it's an overbought, oversold oscillator. It basically measures the chart against itself, whether it be an ETF in this case or the stock, and the performance of it. So 0 to 30 is oversold, 70, 100 is overbought. Between 30 and 70 is neutral, no man's land. A lot of people say, well, it's overbought, it's time to buy. That's not the way I play it. I look for a bounce, a rally, I should say, a breakthrough, a crossover from below 30 back above 30. When that happens, that's what I call an RSI crossover buy signal. I wrote about this in my book, The Swing Trader's Bible, 13 years ago, or 14 years ago. And you can see here, it's tough to see, but we had a little bit of a crossover right there. You can see we bounced for a little bit, but we're getting another one. So when that coincides with sitting on support, historically, it's a very nice sign. The last major one we had was right back here in September. You can see that was about 2 weeks or so before a big rally in the S&P 500. Another one back here, when it was this little pullback, we rallied. Another one right here, again, about a week before a rally. So again, it's not perfect, but a lot of times when it coincides with an index or a stock sitting on support, it ends up becoming a very good buy signal. And I will say, I followed this for decades for the S&P 500, and I've charted it and looked at it. It typically is a very good indicator when it comes to the S&P 500, but we need to see some follow through. So it's something, again, there's a lot of things that are starting to point to some positive situations, if you will, in the market coming up. All right, so, big reason why we've seen stocks fall is because of rising interest rates. And we have the 10-year Treasury at about 1.83% right now. And it's basically flat here today, but we had a big rally on Tuesday, Monday and Tuesday, a big rally from 1.7 to 1.85. It's since pulled back a little bit yesterday, kind of flat here again, about 1.83. You can see in the chart here I pulled up, it's been on a breakout. And let me just zoom out here a little bit to give you a better idea though. As you can see, there's a lot of overhead between 1.75 and 2. I think we're going to slow down between this 1.75 and 2 level and probably consolidate for several months. That, to me, coinciding with tech hitting a correction, coinciding with the support I showed you on some of these equity charts, I think we're close to a near-term bottom here, and I think we're setting up for rally. Because the other thing is the AAIA, which is American Association of Individual Investors, it measures each week bulls and bears. It's extremely bearish right now, and usually you have to take a contrarian view to that the average person, when they're extremely bearish, time to buy. I hate to say that, but that's how it works, and it's been like that for, again, decades. I've been following that. So again, there's a lot of contrarian indicators right now that are pointing towards a potentially near-term bottom. I'm not saying that we can't pull back any more this year, but it's pointing towards a near-term bottom. Let's take a look at ARK here real quick, the ARK Innovation Fund. I like to talk about this because it's innovation and it's gotten crushed and it's in the news. I pulled up CNBC on my computer this morning, and I never watched it, listened, but the volume was on and they were talking about how it's bouncing. So it's up about 4.3% today, as you can see, but it closed at a new 52-week low, down well over 50% from the high from back in February, and trying to get a bounce. But again, is this a dead cat bounce or is this a turnaround? Because if it turns around, it could easily run to 100, and you're looking at a 25% gain. So again, I don't know. It could hit 60 before it gets back to 100. Do I think it gets back to 100 at some point? Absolutely. I think it's a new all-time high at some point. You can't slow down innovation just because interest rates are taking up a little bit. So again, just want to show you that chart here real quick. So Bitcoin is holding support. I'm not going to show you a chart again today. I don't want to do it every show, but it is holding support. It's around 42,700, which is really good to know. And let's talk about earnings. So we are kind of in not the heart of earnings season yet, but we're getting there. We had some big numbers from banks come out this week. About 55 companies in the S&P have reported so far. 76 have beat estimates. 76% have beaten estimates. And last year, about 88% beat estimates. However, last year was kind of weird because we snapped back so quickly in 2021 from 2022 in a pandemic that people didn't know. The analysts stink half the time. The fact that 76 still beat showed analysts still come away and they sandbag these numbers. So for me, we're back to kind of normal 76%. Most are beating by about 8%, meaning if the estimate was $1, it's coming in at $1.08. Again, last year people were being about 15 to 20%, so a little less, but again, back down to the average. So this is it's average. So there's nothing really to get worked up about on either side. But again, I want to just talk about that. And as more earnings reports come out in the next couple of weeks, I'll talk about those and kind of show you where we're going as far as earnings growth for the S&P for this year. So the fun part of the show now, what I want to do is I want to talk about, I thought I had 4, but I have 3 stocks. Maybe I'll throw a 4th one in there for you. A couple of stocks that they're random. You probably never heard of. I do have 4 stocks to get back. You probably never heard of 3 of them, but I want to put them out there anyway and just kind of show you some stocks that have pulled back, that are sitting on support, some that are just beaten up, that I think could be buying opportunities. I'm not, again, nothing here is a buy or sell recommendation. I don't own anything here, but I want you to kind of build a watch list and get in my mind and see what I'm looking at when I look at stocks to add to the watch list. And my watch list is huge because I have the watch list for my own stocks that I buy, and my watch list for obviously our subscribers for everything. So again, it's just something to keep an eye on, and I want you to kind of learn as to how this comes up. So the first company I want to talk about is VICR. VICR is the symbol. And it's considered an electronic components company. And you're looking at the chart over the last little over a year, and you can see it hit an all-time high here around 165-ish, and it's down to 100 right now. So it's fallen quite a bit, and that's just, since it topped out in November. As the Nasdaq moved in the correction, you can see how this stock lost a lot more than just a 10% correction. But let me zoom out, because again, we're long-term investors. And you can take a look. I mean, if you go back to 2016, VICR was in single digits. So, and that's not that long ago. I mean, that's literally 6 years ago. 6 years ago, in that time frame, the stock has more than 25x, around 25x. From there, we're still up about 12x from there. That's huge gains, folks. I mean, that's like portfolio changing, could be life-changing gains. But look at what I want to show you along the way. Look at the pullback we had in 2018. And how that sold off, and then it went sideways for a while, rallied back. That's a pretty significant percentage-wise pullback. Another one, again, it doesn't look like much, but those are pretty significant. That's a bear market. These are all bear market pullbacks. Let me zoom back in again to the snapshot about the last year or so. Very oversold. You have the RSI at 15, starting to turn up, so it's still very oversold. A couple of reasons why I like this company. One, it's about a $4.4 billion company, so it's kind of right in that mid-cap range that I like. It does complete power systems, power converters. It's basically like a battery play, power storage play. And you're starting to see really growth take off just past year, 2021. In 2020, it had revenue about $296 million. 2021, this past year, it's supposed to increase to $370 million, which is a really big increase. And then by 2023, they're estimating that revenue would jump up to about $600 million. So you're seeing a double in about 3 years, from about 300 million to about 600 million. Again, very, very important to see that top line growth. Bottom line is even more impressive. So reported earnings per share in 2020, so about 2 years ago now, of 47 cents. The estimate for last year, 2021, $1.68. Going ahead to 2023, the estimate's for $3.54 a share. So again, in a matter of 3 years, you're seeing this about 8x up. As far as the bottom line is concerned. That's some really impressive stuff. And again, it's in a mega trend. It's in power storage, power modules, battery storage. It's in a really just a great area. And you can see it's just gotten beaten up. Anything growth, anything that just really isn't a popular investment right now has gotten beaten up. And this is what you call capitulation in my mind. So the stock's gotten crushed. I see it again as a potential buying opportunity down here. Could it hit 80 before it goes back up? Sure. I don't know. But again, I like what the company's doing. I love the growth story. Was it a bit overvalued at 165? Likely. But it's probably really undervalued at 100 where it is right now. So again, just put this on your watch list, kind of get in my mind and see why I'm coming up with these stocks. The next one I'm going to take a look at is GTX, and that's Garrett Motion. Interesting play here. As you can see, it just started trading again last day of April of last year. And it rallied from 550 to 875 and going sideways around 7.5 right now. So let me tell you a little bit about this company. It is about a $490 million company. Let's call it $500 million. So it's a tiny company. It's a leader in turbochargers and electric boosting technologies. It's a really big leader in that area. It is a Swiss firm that was spun off from Honeywell in 2018. But remember back in the day when there was this asbestos litigation going on. So what Honeywell did is it took all its asbestos litigation and put it with this company. So it wasn't with the main parent company. So of course it got crushed because the settlement started coming down, and then they had to file for Chapter 11 bankruptcy in 2020. And they had to restructure because of the asbestos litigation. They've been able to do that. They settled, and now they're kind of getting back to what they're supposed to be doing, making these electric boosting technologies and turbochargers for both normal cars right now, internal combustible engines, as well as electric vehicles. So revenue looks it's pretty flat for the most part, but it's around like $4 billion, 3.6 to $4 billion. So it's big money compared to the fact that I just mentioned this company is about $500 million. So it's trading at 1/8 of the revenue brings in annually, give or take. Earnings per share in 2020, $1.05. Then because they're weird numbers, obviously because of the bankruptcy. 2021, they're looking for 64 cents a share, and then this year $1.30, so more than doubling. So you are seeing, again, if this brings in $1.30 and he's given it just 10 times, it's at $13. And again, I just mentioned it's at $7.55. But it's a special situation, as I mentioned, because it is a post-bankruptcy company. So it's always going to have its doubters. But again, because what drove it to bankruptcy was Honeywell's plan on putting the asbestos sector in there, or asbestos litigation in there. And that's behind it now. I think there's some great opportunity. Again, special situation. You don't put a lot of money in these things, or I'm not telling you to put any money into it, really. But my point is, these are the situations sometimes are overlooked by a lot of people, and they end up being great. But I've seen them go, backwards too. I mean, it can go the other way. But again, I just thought I'd share that with you because it's, again, get in my head to see what kind of research that I'm doing on a daily basis to share with you where these companies are coming from. Now, let's go to a big company, which you might have heard of, but probably not. It's a $62.5 billion company. It's called Denso, DENSO. It's a Japanese company. It trades here in the United States under the symbol DNZOY. So Denso was spun off from Toyota back in the day. It was originally founded in 1949, but spun off, so it is a Japanese company. You can see here in a chart, boy, I love this chart. It went sideways for a while, broke out, pulled back on a 50-day moving average. RSIs that were sold. It just looks nice. And let me zoom out a little bit here for you. Just kind of get a bigger picture. I mean, the stock's come a long way. Denso, again, a very big company. Trades here as an ADR. Auto components and systems. Toyota, as I mentioned, it was spun off from there years ago, still owns 24% of it. So Toyota's a big owner of this, which is nice. I'd like to see that backing. Does powertrain systems for electric vehicles. And that's how I originally came across this company about a year or two ago. Because I was looking for companies that make the powertrain systems and really the guts, if you will, of electric vehicles. This company makes the guts of the electric vehicles. Very similar to where you're looking at revenue on this is kind of flat for the next couple of years, around $46 billion. But again, trading at a value of $62.5 billion, you're just trading, about 1.4 sales or so. A PE ratio of 22, PEG ratio, which is the PE over growth, which is more important to me, 1.3, which is very low in this market. Price to book, 1.7. Growth the next couple of years, top line 7% annual. Earnings per share, bottom line 17% annual. So it's got some really nice numbers for a large company. Again, as we see this huge shift to electric vehicles, those auto part companies, the ones that end up becoming the leaders in that, and it's not going to be everyone. They're not all going to be able to shift their manufacturing plants over to EVs. We have one in the McCall report, which is a newsletter we sell for $49. And that is a leader, in my opinion, one of the leaders of auto parts for the next generation of electric vehicles. And this one is maybe one too. It's, again, a bigger company. It's Japanese, but it's you're not seeing the huge growth out of it, but it's nice enough growth. It trades at a nice valuation. It's got a great looking chart that I just showed you. So, and again, this is one that I throw on a watch list. And so far, all three, you probably never heard of any of these three. And they probably add a nice bit of diversification to the portfolio, which is, we're always looking for that too. You don't want to be too one-sided. So the last one I'm going to talk about, you've probably heard of this company. If you know it's public or not, but it's Warby Parker, WRBY. I wish I had my glasses with me. They're over there. You can see it went public back in September in the 50s. pull back immediately. So you never buy an IPO right away, ever. I don't care if you miss it, then you missed it. Pull back to the high 40s, rallied up to 60, but you can see it's gotten crushed with anything else that's like somewhat growth related, IPO related, SPAC related. Having a nice day today, about 7.7% this morning, but hit an all-time low yesterday, just above the $30 range. So Warby Parker is about a $2.5 billion company, and the revenue in 2020 was $393 million. 2021 last year for 543. By 2023, 869 million. Again, very nice growth, folks. Earnings per share, though, this past year, 2021, looking to lose about 50 cents a share, so it's still losing money. But what do I always say for smaller companies like this, or innovative companies, or growth companies, early stage companies, whatever you want to call it? We need to have that path to profitability. The estimate for this year, 2022, is earnings per share of 13 cents. 2023, next year of 31 cents. It looks expensive based on just earnings, but it's just starting to turn a profit. So we want that path to profitability. We see big high-end growth. To me, this is the future of eyeglassware. And there's other competitors coming into it, don't get me wrong. But the fact that they have such an easy way to do it, to buy it online, again, you could try it out, send it back. It's for ease of use. You know, I was in Uber yesterday talking to a gentleman. He had a 19-year-old daughter, a 24-year-old son, a great guy named Gary. And we were talking about this type of stuff, and I always like talking about the market and all. You know, everybody knows I love to try to get ideas everywhere I can. And he was telling me, he was like, you know, people, these kids these days, he called them kids, 19-year-old, 24-year-old, and I call them kids too. They like ease of use. They don't want to leave the house. They don't want to do stuff. They want things delivered. And I said, isn't it funny that I'm in an Uber right now, and I was able to call you up instead of calling a taxi, pick me up right in front of my little villa here. I could take you where I'm going. I could order food if I wanted to right now to be delivered where I'm going. I could do anything from my phone. But 10 years ago, it was around the iPhone, but we weren't doing that. It wasn't available. And it's amazing how times change because, you know, remember on Wednesday or on Tuesday, I did a show on EVTOLs and how that this is tough to comprehend. But again, sitting in the back of his car, I'm explaining that to him. He's like, yeah, you're right. And I started explaining to him flying cars. And he goes, you're crazy. But by the time I got out of that car, he was sold on it. And he's asking about stocks. And that's how it works. You have to just really kind of think outside the box, but you have to equate it to something that's happened in the past. So we have a familiarity with it to be able to connect. If we can't connect and say we're going to have flying cars flying around, it's very tough to do. But if we can connect it with something else, so you know what, you're right. We didn't have these phones and Uber or anything else, Uber Eats or anything that delivers food like that back in the day. We used to call a pizza shop. I remember my mom drive us down. We have to run in and get it and pull out, have cash. Now nobody carries cash. It's a whole other world that's just going to continue to change. And that's why I love innovation. And that's why when I look at some of the stocks I talk about, I don't care necessarily about what they do today, tomorrow, just this year. We're looking big picture, how it's changing the world. These are what we call disruptors, folks. Warby Parker disrupts and disrupted already an eyeglass business that was antiquated and extremely expensive. Remember going as a kid getting glasses and you pick out, it's like, oh, this okay frames, $400, and then you get the lenses and insurance might cover a little bit of it and you still have $400 out of your pocket. This, I don't need insurance. I go over and put my $120 down and I get a pair of glasses. And they're cool, they're hip, and you could get a couple of them. I lose them, sunglasses, whatever you want. I can get my contacts there. It's fantastic. So that's a disruptor. And that's what we want to be investing in, these smaller companies that are disrupting and innovating. And regardless of interest rates, regardless of who's in the White House or anywhere else, you can't stop disruption. You can't stop innovation. And that is what we're investing in for the long term. So if you see companies now that you like, you start picking them up now on this carnage that we've seen in growth in technology, folks. I'm telling you, over time, you will pay dividends. Don't call me tomorrow or email me tomorrow and say, hey, you said buy some tech today and it's down tomorrow. It's not the way it works. We're in this for the long haul. And all you need is a couple of big winners and your portfolio will be set forever. Trust me, I've been there. All right, folks, thank you so much for watching. I hope you have a wonderful rest of your week and have a great, great weekend. I love the support. Thank you so much. And again, it's company day. Stansberry, market-wise, got everything going here. Thank you so much. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.